Welcome to this tutorial. In previous videos, I've taught you how to calculate the value of a bond using the lender's required rate of return, and also how to calculate the value of a bond using the yield curve. In this example, I'll be taking you further on how to calculate the value of a bond using the yield curve when given the government's spot yield curve. From your carry forward knowledge with respect to costs of capital, the cost of capital of a company, which is the KD, is equal to the risk-free rates plus the spread. The spread is a measure of risk of defaults. So for the government, it is expected that the spread will be equal to 0. That means the government's bonds are risk-free. There's no risk attached to the government bond. So the spread of the risk-free rates here, you are not going to add the spread because the risk is equal to 0. But for a corporate bond, there's always a risk of default. And the risk of default is measured by a credit rating agency. The best that a company can have is the AAA. Some company may be on AA, some may be on A, some may be on BBB, some may be on BB and B, just like that. So there's a credit rating that you can use to determine the risk of default on corporate bonds. Let's look into this example and let me show you how to calculate the corporate bond using the government yield curve. Pathway PLC wants to issue bonds that are redeemable in 4 years' time. So these bonds are redeemable in 4 years' time. This is the duration of the bond with respect to redemption. The annual interest is 6% of the nominal value of 100. So this interest here is the coupon. Is the coupon rates on the bond. The current annual spot yield curve for government bond is as follows. So the moment you see this word government bond and pathway is PLC is not a government parastatal. That means this spot yield curve will not apply directly to the company's bond. It will be the spot yield curve of the government plus the spread, which connotes the risk of defaults. So 1-year bond, 2-year bond, 3-year bond, 4-year bond. So these rates are the spot yield curve for each of the 4-year. Pathway operates in the hospitality industry. So the company operates in the hospitality industry. It has a credit rating of AAA. The following table of spread in basis points is given for the hospitality industry. So this is the table of spread for the hospitality industry. AAA, this is the spread that relates to the AAA. So in this question, we're told that the company's bond rating is AAA. So I'm not going to be looking at this AA. I'm not going to be looking at the A either. So the spread that I'm going to be looking at will be the spread for the triple A. Required. Calculate the issue price of the bond. Requirement 1. Requirement 2, calculate the yield to maturity, calculate the duration, and also the last requirement is the modified duration. Now, from your carry forward knowledge, the bond price, how do we calculate the bond price? Basically, it is your interests, present value of interest plus PV of redemption. So it is the PV of your interest plus the PV of the redemption. So that is the bond value. So the next question is, how do we determine the present value of the interest? Going back to the question, what is the interest on the bond? The interest is 6%. The interest on the bond is 6%. The company is going to be paying interest of 6% annually, or we can say the investors will be receiving interest of 6% annually. And at the end of the bond tenure, they receive their principal repayments, which is the nominal value of 100. Let me go back to the solution. From this question, interest is 6 naira. Redemption value of the bond is 100 naira. The duration is 4 years. Lender's required rate of return was not given in this question. We weren't given the IRR, but we're given the spot yield curve for each of the 4 years. The first year was given to be 3.0, the second year 3.5, the third year 4.2, and the final year 5.0. So how do we calculate the value of the bond? The first thing you want to do is to adjust the government yield curve to arrive at the yield curve for pathway, excuse me, for pathway PLC. So how am I going to do this? So the government's yield curve for the first year. So let me put the year. This year 1, year 2, year 3, and year 4. So what is the government's yield curve for year 1? 3.0%. Year 2, 3.5%. Year 3, 4.2%. And year 4, 5%. The spread for AA, triple A, for the very first year is 0.13, which is 13 basis points. So if you have 13 basis points, 13 basis points, to convert it to percentage, you divide it by 100. So to convert your basis point to percentage, you always divide by 100. So if I divide 13 by 100, it will give me 0.13. For the second year, it's 24 basis points, which will give 0.24. For the third year, 37 basis points, that will give 0.37. For the final year, it's 49 basis points, which will be 0.49. Now, this gives 3.13. The second year, 3.74. The third year, 4.57, while the final year will be 5.49. This is the spot yield curve for Pathway PLC, which means the first year cash flow, the interest for the first year will be discounted at 3.13%. For the second year, 3.74%. For the third year, 4.57%. And the final year, the interest and the principal will be discounted at 5.49%. Let's bring in the cash flows for the bond. So year one, what will be the value for year one? 6 naira. The cash flow for year one will be 6 naira. Cash flow for year two will also be 6 naira. Your discount factor for year one will be 3.13%, which will be 1 plus R. And your R here is 3.13, so it will be 1 plus 3.13, which will be 1.313% raised to power minus 1. That's your discount factor for the first year. 1.13%. 1. So this 3%. Sorry, this is supposed to be 0. 3% is supposed to be 0.13. 0.313. 0.313. Let me take this off and write it again. So this is supposed to be 1.0313. So 1.0313. That's year one. Year two, raised to power minus 1. Year two will be 1.0374. 374 raised to power minus 2. And the PV here will be, use your calculator, 1.013 raised to power minus 1 times 6 will give you 5.818. For the second year, it will give you 5.575. Let me bring in the third year. Let me bring in year three. So for year three, what is the discount factor? So the discount factor for year three from the calculation earlier done, 1.0457. And your cash flow still remain 6 naira raised to power minus 3. When multiplied, that will give 5.247. So the final year, year four, the spread for year four is 5.49. So that becomes 1.0549 raised to power minus 4. So the cash flow for year six will be 100 which is the principal repayment plus interest of 6 naira for the final year. That will be 106. When multiplied, that gives 85.597. What will be the value of the bond? When added, this gives 102.23. The value of the bond, requirement 1, the bond price is 102.23. So this is the first requirement. Calculate the value of the bond. The value of the bond here is 102.23. Let's look at the second requirement. The second requirement is calculation of the YTM. So the YTM is the single rate that you will use to discount the cash flow that at the end of the bond duration, the cash flow will give you 0. The present value of the cash flows will give you 0. So for your IRR or your calculation of YTM, which is the same as your IRR, you are looking at PV of outflow and PV of inflows. So for the bond valuation, we are looking at it from the perspective of the investor. So the IRR or the YTM is the investors or the lenders' required rate of return. So it is the lenders' required rate of return. And if I'm looking at it from the perspective of the lender, so as an investor, if I buy this bond from the calculation we did earlier, the bond price, estimated bond price from the bond price was estimated to be 102.237. So as an investor, if you purchase this bond in year 0, just like your investment appraiser, whatever you spend in the first year becomes your outflow. So as an investor, in the first year, I will be spending 102 approximately to buy the bond. So that will be my cash outflow. That is my investments, my initial investments. So what will be my reward or my return on this bond? If I buy the bond at 102.37, it does mean that in the first year, the coupon rate is 6 naira. Interest of 6 naira will be received in the first year. Then in subsequent year, you will receive interest of 6 naira also in the second year. In the third year, you will receive interest of 6 naira. In the final year, you'll be receiving interest of 6 naira plus your principal repayment. So in the final year, the investor will receive 106. So the PV of all of these cash flows, the cash outflow and the cash inflow, discounted at two different rates. Now, when you are calculating your IRR, you want to look at two different rates: the first rate and the second rate. So if you have a negative in the first rate, it means that you need to reduce the second rate that you will be using. So let's look at the way this will be solved. So for your cash flow, start with your year 0. Anytime you are calculating the lender's required rate of return, you start with your year 0, and your year 0 is the investments. What is the company investing in year zero? So let's look at the cash flow for year zero. The cash flow for year zero will definitely be the bond price. So cash flow in year zero will be the bond price. So from our calculation, the bond price is approximately 102.24. Year one to year four, what will be the cash flow? The company or the investor will receive interest of 6 naira every year. That means the company will be paying 6 naira annually, year one to year four. What will be the cash flow in the final year? The cash flow in the final year will be the redemption value of 100. So investors will receive 6 naira year one, year two, year three, year four. And at the end of the duration, the investor will receive 100 naira. So these are the cash flows. Now for your IRR, you want to pick two rates, two discount factor. So if I pick my first rate and the cash flow, both inflow and outflow, the present value of the inflow and outflow gives me zero, then there's no need picking another rate. But it's very difficult for you to just guess a rate that will give you a zero cash flow. Okay, but let's pick the first rate and see what that will give us. So basically, the coupon is 6%. So the way I solve my question most of the time, I want to start with that coupon rate of 6%. So my first discount factor, I'll be using 6% to discount the cash flow first. So for year zero, this will be 1, and the present value, the PV of the cash flow will remain as, so this is an outflow, so I have to put it in brackets. So the PV will remain at 102.24 negative. So 6% annuity, 6% year one. So you do your annuity year one to year four at 6%. So let's see what that will give us. Year one to year four annuity at 6%. So that will give should be here. That will give 3.465. 3.465 multiplied by 6, that will give 20.79. So the final year, 100 discount factor 6% for year four will give 0.792 multiplied by 100 we give 79.20. If this is added up, cash inflows and cash outflows, so 20.79 plus 79.20, so we give you a figure minus 102. So let's see what that will give us, whether it will be positive or negative. So this gives a balance of 2.25 negative. Since it's giving you a negative, negative means minus. So since that's giving me a negative, negative means minus. That means I have to minus or reduce the second rate. So since I've started with 6%, let me reduce the second rate, second discount factor. Let me reduce it to 2%. The second discount factor reduced to 2%. For year zero, discount factor remains 1. The present value remains 102.24 jackets. So 6% annuity, 2%, sorry, annuity, 2% for 4 years. What will that give? Annuity 2%, 4 years. That will give 3.808. When multiplied by 6, the present value of the interest will become 22.85. Discount factor year 4 at 2% will give 0.924. When multiplied, that will give 92.4. So add up, this will give us a positive figure of 13.01. 13.01. So now what will be the yield to maturity using your IRR formula, which is this formula here? Lower rates, a lower rate here, LR is a lower rate, which is 2%. The higher NPV is always the positive NPV. So the positive NPV is higher than the negative, so which is 13.01. So this is your lower rate, 2%. Higher NPV, 13.01, all over the higher NPV, which is 13.01. So minus will give you plus. So plus 2.25. Then higher rates minus lower rates. So your higher rate here is 6% minus 2%. When you do this calculation, the final answer you're going to be having will be 5.4. The third requirement is to calculate the bond duration. Third requirement is the calculation of the duration of the bond. Calculation. So how do you calculate duration of bond? It's just the same way you calculate your duration in your project's investment appraisal. So that's the same way we are going to calculate the bond duration here. Bond duration. So how do you calculate the bond duration? The YTM was calculated, the yield to maturity was calculated as 5.4%. So this yield to maturity from the very first example, sovereign bond value, the bond value was discounted, or the cash flows were discounted at the lender's required rate of return, which is the YTM, to arrive at the bond value. So this YTM now that we've gotten is a single rate that the company or the investor can use to discount their cash flow to arrive at the bond value. So if instead of using the yield curve to arrive at the bond value, you can use the YTM if you have the YTM. But in this question, initially, the YTM wasn't given, but we needed to calculate the YTM here. So how do you calculate the duration? So this YTM of 5.4% Cash flow year one is 6%, cash flow year two, 6, year three, 6, and the final year 106, which is interest plus principal, discounted at 5%. So year one will be 5.6, 5.4, 5.1, 85.891. So because of approximation error, this should have given you the same value we had for the bond valuation using the spot yield curve. Using the spot yield curve, we got a value of 102.24. So because of approximation error, here we now arrive at 102.109. But normally it should have given us 102.24 if we had not done any approximation. Okay, so this area here of this solution is the calculation of the bond value in another way. So this is the bond value. Okay, but if not that I wanted to calculate the duration, I would have just done cash flow year one to year four, which is 6 naira, 6 naira, discounted at 5.4, which is the YTM. That would have given me a value. And the final year, I would have just said 100. Year four, I would have just said 100, discounted at 5.4. That would have still given me this same value. Okay. But because I want to calculate the duration of the bond, I need to separate the cash flow year one, year two, year three, and year four. So this is supposed to be the weights. Sorry, here supposed to be weights, not PV. So your weights will be the year. So this year represents the weights. So weight for year one, you just bring your year back, year 1, 2, 3, 4. So that becomes your weights. So the next column, you just add only 2 columns. This first column you'll be adding will be column for the weight. And the second column will be the column for the weight times the PV. So which will be 1 times 5.6928. So here we will remain at 5.6928. So the second one will now be 5.4012 times 2. So that will give 10.8024. So the next will be 5.124 times 3, which will give 15.372. The final is 85 times 4. That will give 343.6.5, 343.564, 564. So if this is added, it's going to give 375. 375.4321. 375.4321. So your duration is just simply the summation of the weight times PV all over the summation of the PV, which is this over this. So 375.4321 all over 102. So if you do that, that will give you 3.67 years. So that is the bond duration. So the final requirement is to calculate the modified duration. The modified duration is simply your Macaulay's duration, which is what we calculated earlier on as 3.67 all over 1 plus your YTM. The YTM was calculated earlier on to be 5.4%. So your modified duration becomes 3.67 plus 1, 3.67 all over 1 plus 0.54. This is your YTM. So the modified duration gives 3.5 years, which is 3.5 years. So this is the way to solve a question with respect to bond valuation, we are giving the government yield curve to calculate the value of a bond. A recap, when giving the government yield curve to calculate the value of a bond, the first thing you want to do is to adjust the government yield curve. You adjust the government yield curve to reflect the risk of defaults for the company, which will be measured by either a triple a triple B, whatever the credit rating of the company is. So that's the very first thing you want to do. So in this question, the examiner asked you to calculate, first of all, the bond price. Secondly, the YTM. But your examiner may just ask you to calculate the YTM straight without giving you, excuse me, the examiner, excuse me. So if your examiner asks you to calculate the YTM without telling you to calculate the bond price, you should know that for you to calculate the YTM, you definitely need to calculate the bond price first, if not given, because your YTM is the cash outflow, the outflow for year one, which is for year zero, sorry, which is the bond price. So for you to calculate the YTM, you must have the bond price, you must have the interest, annual interest for each of the years. So your YTM now becomes your outflow, your inflows, which is your interest plus principal repayments, discounted at the very first rate, whatever you have. If it's a positive figure, you increase the next rate. Positive means increase. So if it's a positive figure, you increase the next rate. But if it's a negative figure, you reduce the next rate that you will apply to the bond or to the cash flows. So this is just how to calculate the bond price when giving the government yield curve. And we also look at how to calculate the YTM, how to calculate the duration of a bond, and also how to calculate the modified duration of the bond. If you like the video, subscribe and share. Thank you.